Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
Hey, and thanks for having me back, Jim.
Ross, is it really true that foreign students at UBC are inflating Vancouver condo prices?
Yeah. So there is pretty much no question about that now, Jim. And we really, when there are so many influences on a housing market. There are just so many components that impact the market. Everybody is always looking for the quick fix, the quick explanation, and at times, we fall to that ourselves. The condo rise, as you know, on previous shows, we've told everybody that generally that 2017 period where the $37,000 boost, that had a lot to do with the condo price increase, and we basically could attribute it almost all the change to that number. The only problem that we had was we didn't have the numbers of purchases that should have been recorded using that $37,000 boost. So we've watched as academic after academic after academic from UBC and Simon Fraser have come out here with a whole bunch of a wide range of excuses or explanations for why housing prices have changed. And that just got us thinking because of the condo increase. And what impact do the universities have on the housing stock and the housing prices in the cities that they're located? Now, to be honest with you, Jim, we always understand how universities impact the investor market. So people are looking to invest in real estate. Ideally, most people should be looking at a university town. I mean, that's just simply one of the best and easiest ways to invest in real estate. There is also a concentric ring theory when it comes to investing in real estate in university towns, where the closer you are to the university, the greater your return on your investment is going to be. The further you move out, the less you should be expecting. So what we did is we went back and we wondered, was the data available that would record changes in student populations? Well, when we looked in Vancouver specifically, so we've done this now for all the major cities. Calgary, we've looked at three different cities here in Ontario, and we've looked over at McGill. So we've applied this model to all these different places to make sure we're not making a mistake. But where it really comes to bear is in Vancouver, and specifically for the University of British Columbia, who also has the highest number of academics out there in the marketplace spouting off about house price change, and in many ways issuing socialist propaganda about recommendations for change, which inevitably mean wealth tax, lower lifetime wealth accumulation, lower home ownership rate, higher government ownership or inclusion or control over the housing stock. So let's look at the University of British Columbia, and let's look at what they did with their enrollment numbers from the period between 2013 and 2018. So basically, we're covering 5 calendar years of student attendance at those universities. Well, what's really blatantly obvious when you look at the inside data, which is published by the university itself, was that there was a small increase in the enrollment at University of British Columbia, of that, let's see, what's the numbers here? Let me give you the exact numbers. It went from 58,300 up to 64,900. Now, that doesn't sound like a big deal. Now, to us it does, because we also know that the University of British Columbia did not add housing stock to accommodate those extra, about 6,700 students. They didn't add it. So then that gave us a second thought. We know this, the foreign influence. We know that when a student comes and there's a propensity to have another parent come with them while they attend the university, or extended family of some sort, we know that there is a multiplicity of impact on a local housing market. So we did some further research and we looked at the domestic students. Want to know something? In those 5 years, domestic students only increased by under 700 students. It was basically 60,000 students. 760 extra students from Canada attended UBC. But foreign students at the Vancouver campus at UBC went from 9,371 up to 14,685. The vast majority, overwhelming majority, almost all of the enrollment increase is solely attributed to adding new foreign students. But what the university didn't do was add bedrooms for those students to sleep in. That means between 2012, start of September of 2012, and graduating of 2018, there was an extra 5,300 bedrooms in Vancouver that had to go to foreign students. That's not taking into account if they had a parent or a guardian come with them. Now think about that, folks. There were only 17,000 condos added to Vancouver during that period. What that means is any of the studio apartments, the 1+ den that were built during that period of time, could have gone solely to foreign students. It means that the rental stock that would have been available for local Vancouver residents was taken over by foreign students. Over 30% of the housing stock that was added would be inhabited by foreign students. Because you have to understand, listeners, your domestic students only increased by 700. So there were 700 bedrooms that you had to find. Those numbers basically were unchanged. Maybe with some local students, people who lived within a driving distance, they're going to continue to live at home because of the cost of housing. But those international students, those foreign students, they all needed a place to live, and it took basically 30% of the new housing stock that was added. Now, when you apply standard housing market math and you account for 30% population growth, that means there's only 70% of the housing stock that was added in the overall housing stock that was available to local residents, Canadians. And the housing stock occupied by students is generally the lowest price units. So it puts upward pressure on the lowest 2 quintiles of the housing stock. About the lowest 40% of the rental housing stock, the most affordable, could very well have been taken up by foreign students. I'm not even going to discuss what Simon Fraser did. We're not even going to discuss that. We're going to leave this discussion strictly with UBC because it is outrageous that they added 5,000. Basically, they increased their foreign student count by 50%, and they didn't add bedrooms at the university for those students to sleep in. That meant those students had to go in and take bedrooms from local people in Vancouver, and the university has remained silent. There has not been a study done discussing the impact of student housing on the local housing stock in terms of affordability. There has not been a single mention of it by any academic. None of the groups that are active in the marketplace, Generation Squeeze, Tom Davidoff, people who are in the media discussing it, they've always been seeking other blame instead of putting blame where it is. Over 5,000 bedrooms are now occupied by foreign students that weren't occupied by foreign students a short 5 years ago. Now, it gets worse for your listeners because this got under our skin a little bit, and we started to do a little bit more research into student housing in general. There's about 9,000 housing units at UBC. So they have 9,000 housing units for, 65,000 students. Okay, so we see a high percentage of those housing units are going to have to be, the students are going to have to go out into the local marketplace and find some place to live. We already know the foreign count fully takes up that 9,000 plus. It's double. It's 50% higher. So we have to look at what are the rental opportunities, because we looked at the enrollment. We looked at the attempt that they try to put first-time students in local, on campus, in the campus housing stock. So then we looked at the prices. Well, I'm sure your listeners, there is not a listener out there that's searching for affordable housing who would not jump at the prices offered for the student housing on the UBC campus. The prices that they offer are the best in Vancouver. It is the most affordable housing stock in the entire province. They have 4-bedroom townhouses for rent that rent out at $2,200. And if you have one of the husband and wife, plus the 3 kids that live there, that attends UBC, that's what you can get that housing unit for. Now, you probably have to get on a waiting list because they allow these families to live in there for 4 years. The cheapest rent in Vancouver. When we're looking at a lifestyle, the cost of living, a student living, it's cheaper for someone in Vancouver working in McDonald's full-time to apply to the University of British Columbia and get residence and a meal plan than it is for them to rent an apartment in Vancouver. So what your listeners need to understand is this. UBC's enrollment, which is removing bedrooms, condos, from local families, driving housing prices up, is solely the result of the university not able to afford to house their students. Their rents are so cheap, so low, the UBC could not build houses that the students would be able to afford at market rents. So what have they decided to do? Not build. And then we've looked across the nation at this problem. And this is a huge problem in Canada today when you look at the number of foreign students now attending Canadian schools. There is no question in our minds as of today, outside of the standard manipulation of house price change through the MLS system, that foreign student counts in this country have caused the greatest house price pressure in Canadian history. There is no other factor that impacts the population and the housing stock and house prices more than the removing of bedrooms from local residents. And it is a staggering impact that is demonstrated right in Vancouver with UBC. Yet there has not been a single study out of UBC or a single mention of it out of UBC that UBC itself was the cause of the affordability crunch in Vancouver. And our research now clearly places blame at UBC, and they're arrogant in adding an additional 5,700 foreign students at a time with local families could not even get a bedroom to live in, and they've remained silent. So when you're talking about housing affordability in Vancouver, right now, everybody's finger should be pointed at UBC. And every academic that is employed by UBC who has remained silent about it, but who's talked about the housing market, must be held to account. Because I'll tell you, Jim, the listeners that you have out there, they're being impacted by this. I know right now, when we look at, London, Ontario, University of Western, we look at Brock University now in the Niagara area. We're looking at the University of Toronto. These same price pressures are appearing everywhere. So it's the local, low-end worker, the guy who's making minimum wage, the family that's trying to get by on double minimum wage, who cannot get a place to own because some wealthy foreign student is attending a local university, which the Canadians' tax dollars itself are supplementing. I mean, I don't believe the University of British Columbia even pays property tax to the city of Vancouver, does it, Jim?
I don't know. It's UBC's a unique animal. They don't belong to city council. They have a representative in Victoria. So they're a provincial organization.
Correct. So not only Do they not support local Vancouver through property taxes? They are actually removing bedrooms, forcing property taxes to be higher. So we'll just leave it at that. We'll leave it for your listeners to inquire why, when over 5,000, the enrollment increased by over 5,000, only 700 Canadians, but over 5,700 foreign students were added to the enrollment at UBC. Has this never been discussed?
We'll have more with Ross Kay right after the break.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Ross Kay. Ross, one of our listeners asks, we're longtime listeners. We've been married for 5 years, starting to grow our family. We believe in your idea of where we will set down our roots will determine our financial lives going forward. What best first steps would you recommend we take?
Well, they've taken the first step, Jim, because they're thinking about it. They're actually thinking about their life today. Probably these people are thinking about 10, 20, 30, 40 years from now. And that is the most important first step that people can make. Look, when I started out, no one told me, hey, Ross, you've got to think about your family 10 years from now, 15 years from now, 20 years from now, 30 years from now. You've got to think about those things when you decide to start calling someplace home. Nobody told me that. And my mother and father were two of the top selling real estate professionals in North America at the time when I bought my first house. So I wasn't selling when I bought my first house. What I learned, 30 years later through my own personal life experiences is that where you set down roots has overwhelming control over your life. You can imagine, I had 4 kids. They all grew up in the same town of Burlington here. I'm now looking at houses in Burlington that, starting at $500,000 for a townhouse. And that's at the low end. What kind of life are my children going to have if they believe that they're going to start their lives here? So what I'm saying is they built their entire life in this city. All of their connections are here in this city. All of their history is here in this city. And now they're faced at they're starting their lives and they really need to start looking about moving somewhere else where it's more affordable. And that's really the next step that everybody needs to look at. You need to sit back and you need to look at your income stream. You need to look at how much after-tax income you have coming in every month. You need to look at what is your annual income going to be? What is your income forecast for the next 5, 10, 15, 20 years? Where are you going to be? Where you're working? Is that going to deliver a pension that's going to allow you to retire? How much are you going to rely on your investment? Is home ownership going to be part of that investment? I hope it is, because I know home ownership, unlike what the financial advisors say, is the basis for which all wealth in the world is built on. So that's one of the steps that you need to take. You need to look in the future and try to guesstimate where you're going to be. We know today most people are going to go through several jobs before they finally reach a job that they're going to be in for a while. And odds are, the way the world is evolving, that's going to change too. If you choose to set down roots somewhere where population growth is going to dictate that house prices continue to rise and that only a wealthier and wealthier percentage of the population is able to own homes, then when the next generation of your family starts, or when your kids are coming out of university, they may no longer be able to live in the community that they grew up in. So you need to step back and look at things this way. That's where the whole process that we talk about, that we recommend, start. You said they're married, and it says they're starting to think about having a family. Okay, which means kids. Well, we're seeing in the papers today about daycare. People paying $1,500, $1,800 a month to put a child to daycare. Well, assuming they go to 10 months of the year, that's $18,000 a year just for childcare. Okay, that's the interest, the full amount of interest per year on a $500,000 home in other communities. So you need to probably earn double that, because I'm assuming these people who are using childcare, this is their top income dollars that are coming in. You know, the highest taxable dollars that they're earning that is funding this childcare. Probably have to earn somewhere around $30,000 extra just to put the child in daycare. Well, that means you can take a $30,000 discount in earnings to go to a city where it's going to cost you less to live just on daycare. We also have the price of the home. We have property taxes. We have lifestyle. If you're living in a neighborhood where people don't replace their cars every 3 years, where everybody's not driving a Mercedes or a BMW, then maybe they're driving a 8-year-old vehicles as common, your life expense is going to drop as well. So all of these sort of things are what needs to go into this conversation. These are the sort of steps that you need to be taking. But in this case, the very first step they've already taken. They're thinking about it. They're thinking about where they're going to be years and decades from now. And what I can tell you is, Jim, is you would probably agree with me, time goes by so fast. It goes in a blink of an eye. You're so busy living your life, you're not watching time go by. Having these discussions, having a long-term outlook, that's what's going to set you up for success. And that's what I hope you take from this, the best recommendation that you take from what we're talking about.
We'll have more with Ross Kay right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Ross Kay. Ross, today, what you called organized real estate claimed in June home prices had risen 0.3% in the last year, and sales had gone up. We know you read the data differently, and since this is making headlines today, what did you read into it?
What I read into it was propaganda, once again, to earn commissions. Home prices, the average home buyer in Canada during June spent less on the home that they were buying. They did not spend more. Prices did not increase on the national level. What happened on the national level was, as it has been going on since early 2016, when the Vancouver housing market was reached its peak in March of 2016, the shift of sales nationally has been making a radical change. This radical change shows up in the average selling price reported by Organized Real Estate. What the Bank of Canada calls frothy, what they mislabel as being frothy, is actually simply recording a time in the market when first-time buyers' share of sales drops off. The sales chain ends. First-time buyers' share of sales may drop from 17 to 5% over 2 or 3 month period. That means you get ridiculous claims of house price change because those buyers aren't buying in the market. The only people left that's buying are trade-up buyers. And this gets worse, increases with each passing month for a 3 to 4 month period. That is the only way that you get a frothy house price increase year over year of 25 to 30% that was claimed in Vancouver and then claimed in Toronto. It wasn't frothy. It's just a composition of sales change creating house price illusion at its maximum. Then the following year, we hear the stabilization myth. So it's the frothy myth one year, the stabilization myth the next. Economists are all searching for an answer. They're all waxing poetically about the housing market because they don't have an answer. They can't read the data. A stabilized housing market simply means the sales mix is unchanged. When the sales mix is unchanged, the buyer mix, the group of buyers buying, let's say you got 30% first-time buyers, 30% first-time trade-ups, 30% second-time trade-ups, and you got another 10% of the luxury class. If that group of buyers stays identical, and the mortgage interest rates stay basically unchanged, in other words, the amount of mortgage money you're qualified to buy under the Government of Canada rules is unchanged, nothing's going to change. So it looks like it's stabilized. Well, a housing market is never stabilized. A housing market is always moving. It is always changing. These short periods of time, 2 or 3 months, where you may get a sales mix that appears to be unchanging, passes. That was a stabilization myth. And today, Jim, they have the boring myth. Today, the headlines is the Canadian housing market is boring. It's not changing. Well, what's really going on with boring is pretty exciting. Because what it means is the stabilization myth has been believed, and now the fact that people are getting buying a higher and higher quality of house per home buying dollar is not being seen. They still think it's stabilized when it's not. They think the housing correction is over when it's not. The housing correction, in theory, Jim, is only about a quarter of the way in, maybe a third of the way in right now. This is another myth that has been created. So we've gone from the frothy myth to the stabilized myth to now to the boring myth. All because economists don't know how to read housing data. Listeners, we only just finished looking at our May data. You couldn't even look at June data probably till right about now. All of the numbers that the Canadian Real Estate Association released today were starting to be counted on the first day of July. You can't do that. On the first day of July, you can go back and probably look at your May numbers. You can probably come back with a legitimate measure. The reason we don't produce charts where it says housing market's busy this month, next month housing market's slow this month, next month housing market's busy, next month housing market's rise, next month housing market's drop. The reason we don't get those kind of results is because we wait till we have the data. We don't report on the 1st or the 2nd of a month, or the 5th of a month, or the 10th or 15th of a month. We wait till the beginning of the following month. Because our metrics are so leading the market, because we have such a large window of over a year. Even when we're reporting May today, we're still 11 months ahead of everybody else. So, when you read the word boring in tonight's news headlines, that is the third identification of a housing market as a myth that has taken place in the last 3 years. We have gone from frothy, Bank of Canada itself announced it. Stabilized, Bank of Canada itself announced it. To boring, bank economists today started to drink that Kool-Aid. Housing markets move in the identical way every place that they function. What you're looking at constantly is no house in North America changes value in 28 to 31 days. It does not happen. The only thing that happens is a shift in the sales mix. That shift in the sales mix creates house price illusion because it's cyclical. That house price illusion gets believed. And then over 100 years, because you got to remember, some real estate organizations in Canada, like in Saskatchewan, has been in existence for 100 years. It's belief. Frothy, stabilized, boring. They're all myths. They're all inaccurate. And if you're making a financial commitment of $500,000 to $1 million using it, you're not going to go anywhere. I'm sorry to say, folks.
We'll have more with Ross K. right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, a general question a couple of listeners asked after last week's show about using a HELOC to withdraw money to invest elsewhere. Can you give them a little guidance on that topic?
Yeah, sure. So this is a touchy topic, and it's a touchy topic because people are afraid to borrow against their home to invest in other asset classes, i.e. the stock market, for the sake of the argument. Okay? So I understand that reluctance. I understand that fear, and I understand it because the falsehoods that are stated about a housing market create this inability of homeowners to step back and look at their house as an investment like anything else. So that's what we do. We step back and look at your house like a standard investment like anything else. Your house is just a bunch of stocks, the same way you can go buy a bunch of bank stocks. Okay, that's how we look at it. What you need to understand is that your house price profile going forward is going to move on a path that is readily recordable. So you're going to be able to record where your house price path is, where your house's value is going to be. Now, it's going to take turns, but you can be measuring that, and you always have a year's advance notice of where the value of your home is going to be. So people in Calgary learned this in 2013 when we said it. People in Vancouver learned it in 2015 when we said it, and people in Toronto in 2016 people learned that that's what's going to happen. Because right after the next spring of those years, the housing markets corrected exactly how we said they were. This is not super knowledge. This is simply we understand how housing markets work. We know how to measure them, so we're just measuring them that far in advance. We can't be wrong. If we're wrong, we'll give you your money back. This is not even a debatable topic any longer. Everything has been recorded on Howe Street. Everything has been recorded on CBC. Okay? So those two sources, you can go back and check anything that we have to say. Your HELOC, you should never really carry more than about 40% of your house as home equity. So once you hit that 40% threshold, you have a loan-to-value ratio of 60%, you really should not be paying down your mortgage anymore. Now, I know everybody says, well, Ross, what if my house drops 20%? Okay, you need to be tracking that ahead of time. So these fears dissipate and eventually are eliminated from your life. You need to have a financial advisor who understands that this money and the fears that you have about using it needs to be utilized in a way that eliminates or reduces risk. We're advocates of bank stocks. So I will leave it to your financial advisors to provide a contrarian viewpoint on this to us. It really doesn't matter because we don't sell stocks, so we don't make any money from it. We like bank stocks because we never think about selling the stock. All we're interested in is the dividend. So right now, CIBC is paying us about 5.3% at today's stock price. But we actually look at it from our call to buy from the spring, just after 2009. So we gave a buy call for all bank stocks back then. If you had bought your bank stocks back then, and you had simply bought one share every single month since our call in 2009, you would be getting somewhere around a 13% annual rate of return on your as a dividend. Okay, it is just tremendous. We would tell you, forget about it. You're never going to sell the stocks. When you die, you're going to leave it to your family. You're going to leave it to some charity. All you're looking is at the dividend. The banks we like because the banks work with the housing market. So we knew CIBC's share price was going to fall before it fell, because we knew how their mortgage book was being built. We knew the thresholds that when they were going to have to pull back. When they pulled back, we knew that the other banks were going to step up and book and increase their mortgage portfolios. So we know that their share prices would have increased. Now, I'm not saying I can tell you what's going to happen with the bank stocks. All I can tell you is, based on historical patterns of the home trading market, how the banks interact with the home trading market, how their profit margins are generated, we have a pretty educated guess on what's going to happen with the value of the stock. That said, we don't care anyway. All we're looking at is the dividend. And those dividends are rock solid. There is basically nothing that's going to happen, barring a world war or a total collapse of the economy, that those dividends are not going to be paid. That is the reliability of those stocks. And that's how you should look at this issue. You're borrowing your money from a HELOC, and you're going to put it into another investment that you're going to own as long as you own your home. Maybe you're never going to sell your home, and maybe you're never going to sell those stocks. All you're going to do is, 30 years from now, have a house that you live in, that all you have to pay to live there is the property taxes and the maintenance on the property, because it's paid off effectively, and you're going to collect the dividends from whatever stocks that you bought, and you're going to live on that. And in today's the new people starting out, it's even better, because you've got your TFSA. This money is going to be tax-free, unless UBC professors convince the government that they want to have a wealth tax on the smart 30, 40-year plan that you put into place. Now, I can't say whether the country will move to a different political climate 30 years from now. But what I can say is, as long as Canada remains on the path that it's on, you should not leave more than 40% of your equity, your home equity, in your home. You should diversify your portfolio. You should be monitoring the 1 and 2 year house profile, value profile on your home, so you're never caught off guard. So if you see a 5% decrease in your home's value happening at a time where your loan-to-value ratio is at 40%, well, maybe that is a time that you use some of those dividends to pay down your mortgage. Maybe that's time that you borrow other funds to keep with your investment portfolio, and you do pay down your mortgage. If your house is increased over the first 3 years of your plan, odds are you can take another 10 to 15% hit in value and still have over 40% equity in your home. That is the beautiful thing about a house. The beautiful thing about home ownership is that you can forecast where you're going to be a year from now with such a high degree of accuracy. There's really nothing to worry about. I mean, what are you going to make, a 1 or 2% mistake? So if it's a $500,000 home, your estimate may be out $10,000. That's nothing. There's no other investment where you can do this, where you can forecast where you're going to be at least a year out from now. Utilize that opportunity. Talk to a financial advisor. Get their opinion. Do it in a no-risk manner. That's the way that you use a HELOC. And don't forget, if you use a HELOC and you're investing, probably your financial advisor can help show you how to make the interest on that HELOC tax deductible. It's a double whammy in terms of wealth building.
Ross, thank you so much for chatting with us.
Thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. If you have any questions for Ross, you can send them to info@housestreet.com. Find us on Twitter @HouseStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HouseStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HouseStreet.com radio is a production of House Street Media Incorporated.